Welcome back to my channel Quest for Knowledge. Now we are going to discuss important 5 marks of financial management. So the first question is, what are the function of a finance manager? Okay, so let's discuss. The function of a finance manager is that he has to estimate the total financial requirement through making the sound financial plan, and the finance manager should select the right source of fund at the right time and at the right cost. The finance manager should have to make effective investment of fund in order to make it profitable avenues. It is the responsibility of the finance manager to protect the interest of the stakeholders like creditors, shareholders, employees, everyone. The responsibility of maintaining the liquidity position of the firm is at a high level vest in the hands of the finance manager. The finance manager has to manage the assets and liabilities of the business, and he has to manage the expenditures and even the balance the various sources of funds and income of the business. Okay, so this all has to be done by the finance manager. The finance manager has to take proper decision regarding the financial requirement of the business, everything. So these all are the various functions of finance manager. To the second question, what is the capital structure? Explain the factors determining the capital structure. So what are the capital structure? First is the accessibility of fund. First is the accessibility of the fund. The total amount of fund which is available for an organization, so it should be in the form of share, debenture, etc. So the affect the capital expenditure decision. So it is sufficient funds are not there with the organization, then expansion is not possible. So that is the thing, that they have to maintain the shares, like what and all their funds are, and even their expenditure, and whether it is their liquidity. And so first of all they need to understand the availability of the fund. Second is the structure of capital. What is the structure of the capital means? It is the content of capital, okay, like debt or equity, so that they can understand the benefit of leverage. After that, we have the taxation policy. They need to understand the various policies regarding to taxes, and then government policies, subsidies, any kind of a fiscal policy, industrial policy, concessions are available for the various undertaking of what, lending policies of financial institution. If they are going to get the sources of fund from bank and financial institution, they need to understand the policy and schemes regarding over there. And then what is the immediate need of the project, based on to that they have to work, and what will be their earnings, that also they need to understand, and what will be the capital return, and what will be the economic value of their project, how they are going to do it, and how much of the cost will be they incurred for the working capital, and what and all the various accounting practices they have to go through, everything they need to discuss for it. Okay, so these all are the various capital structure, the factors influencing capital structure. So students, these all are the factors which are affecting the capital structure of a firm, which is trading on equity. Okay, desire to retain control, size of the company, nature of business, amount of capital required, cost of financing, growth rate, period of finance, flexibility, profitability, timing, taxes, attitude of lenders, and purpose of financing. These all are the various factors which affects the capital structure of a firm. So students, to know more in detail, we can understand there are various factors which affecting capital structure in an internal and external way. So internal is the financial leverage, our risk, our growth, stability, how is our retaining control, what is our cost of capital, cash flow, flexibility, what is the purpose of the finance and asset structure, everything is internal. External is the size of the company, nature of the company, investor, cost of inflation, legal requirement, period of finance. So all that comes under the external. Okay, by this we have completed a capital structure. Explain the factors determining capital structure. Now we'll discuss the model paper 2 theory first. First, we'll discuss some more important theory. What are the types of financial plan? So there are types like cash flow planning, investment planning, insurance planning, retirement planning, real estate planning, and tax planning. So these all come under the types of financial planning. To know more in detail, there are short term, medium term, and long term financial planning. So the short term will be of 1 year. It only looks about the working capital need of the company. Medium term belongs to 1 to 5 year. Looks after the replacement and maintenance of the asset. Long term is the period after 5 years, where they discuss only about the long term objective of the company, capital structure, expansion activities, everything. So the characteristic of a sound financial plan, first it should be very simple, okay, and what we need to know the purpose, and it should be flexible, okay, suitable and changeable according to the situation and circumstances. And a sound financial plan is that it should be liquidity, there should be liquidity into it, and it should be economical, and it should know how to face the contingencies, and it should be uniformity, and the main thing is that there should be availability, and it should be realistic. The planning should not be unrealistic. Principles of financial planning, there should be principle of conformity, consistency, and constancy of net working capital. Is there any surplus cash? Principles of return on investment, balance of risk, and adaptation to the need of the market. So these all are principles. So, more common principles of financial planning is that long-term capital, corporate objective, there should be, it should be simple, very realistic, flexible, economical, liquidity should be there, appealing to investors, effective and optimum use of fund to be done, and balance of owned and borrowed capital, they need to balance it, and they should secure the interest of the investor, and they need to collect on timing basis. These all are the theory which are very important. Now we'll discuss, explain the significance of financial and operating leverage in financial management of a firm. So what is the operating leverage and what is financial leverage? So operating leverage is associated with investment activity of the company. Financial leverage is associated with the financial activity of the company. Operating leverage consists of fixed operating expenses, but financial leverage consists of operating profit of the company. Operating leverage represents the ability to use fixed operating cost, but financial leverage represents the relationship between earning before interest and tax and earning per share. Operating leverage can be calculated by that is C divided by OP, but financial leverage has to be calculated by OP divided by PBT. Okay, a percentage change in the profit resulting from a percentage change in the sales is called as degree of operating leverage. A percentage change in the taxable profit is the result of the percentage change in the EBIT. So trading on equity is not possible in operating leverage. Trading on equity is possible with the financial leverage. Operating leverage depend upon fixed cost and variable cost. Financial leverage depend upon the operating profits. Tax rate and interest rate does not affect the operating leverage, but here the tax rate and interest rate do affect the financial leverage. So now we have understood what is operating and what is financial one. That you need to give the significance of financial leverage. The significance of financial leverage is that it is positive cash flow position, it increases the shareholders profitability, it gives the tax relaxations, and it is followed because of the financial leverage we can expand the business ventures, it improves our credit rating and the economies of scale. So what are the significance of leverage is that operating leverage is one of the technique to measure the impact of changes in sales in our day to day transaction for the change in the profit of the company. So if any change, it will lead to corresponding changes in profit. So operating leverage help us to identify the position of the fixed cost and variable cost. Operate leverage measures the relationship between the sales and revenue of the company during particular period of year, example year. Operating leverage helps to understand the level of fixed cost which is invested in operating expenses of business activity, and operating leverage describe the overall position of the fixed operating cost. So overall, the leverage refers to the relationship between two interrelated variables. In financial analysis, leverage reflects the responsiveness or influence of one financial variable over the other. So it quantifies the relative changes in profit due to sales. So it helps in forecasting, it helps in taking proper decisions, and we can understand the relationship between two variables. So these all are the significance of leverage, whether it is financial or operating one. And this question is surely going to be asked for your 15 marks or 5 marks.